Vietnam wrapped up the first half of 2025 with strong momentum, achieving 7.5% GDP growth, the highest first-half performance since 2011, despite ongoing external challenges. Tariff uncertainty began to ease when Vietnam became the third country to have a trade agreement framework with the Trump administration. Under the deal, the U.S. will impose a 20% tariff on Vietnamese exports and a 40% tariff on goods identified as transshipments. In exchange, Vietnam has agreed to eliminate tariffs on all U.S. imports. Although further details are still being discussed, Vietnam has managed to secure a more favorable tariff rate than regional peers. We believe this initial outcome will help restore confidence among manufacturers and investors, paving the way for continued growth and stability. Vietnam is pushing ahead with its most aggressive and fast-paced reforms in decades. The government is aiming to turn investment, which is now only 31.7% of the GDP, into a true growth engine. In just 1 year, big changes have taken place. Ministries and provinces were merged to cut costs, and the government expects to save around $7.3 billion over the next 5 years. Those savings will be redirected to spending on education and technology, laying the groundwork for long-term growth. At the same time, the government is stepping up efforts to boost revenue by tightening tax collection in areas such as real estate and e-commerce, which have often been underregulated. The business environment is opening up like never before. For the first time, private companies have been given the green light to join national mega projects, reflecting the country's ambition to develop its own chaebol corporate groups. One of the most prominent examples is the $67 billion high-speed railway, expected to begin construction by the end of 2026. Two major private firms have already submitted proposals to take part in the project. Vietnam is also moving quickly to integrate with global markets. In 2025, pilot programs for digital assets and a carbon trading market are set to launch. Ambitious long-term initiatives such as building international financial centers and free trade zones have also been approved by the National Assembly. All of these bold moves are starting to turn heads. Major players like Morgan Stanley and JP Morgan are now taking a brighter view of Vietnam's economy and stock market, signaling a growing wave of global interest. We've revised our GDP growth forecast for Vietnam in 2025 from 6.3% to 6.8%. This reflects growing expectations that more international orders will shift to Vietnam, especially in sectors where the country has strong domestic value-added production. Construction is also set to pick up speed, driven by rising infrastructure investment and a new wave of residential projects. Interest rates may edge up as credit growth remains strong. However, with inflation expected to stay well contained at around 3.7% by year-end, any rate hikes should be modest. Although the Vietnam dong has depreciated by 3% so far this year, we see potential for a rebound. Tighter oversight on capital outflows is expected to reduce unrecorded transactions, while the U.S. Fed moves closer to rate cuts, both of which could support a stronger currency going forward. The VN Index, Vietnam's benchmark stock market index, delivered a total return of 6.9% in US dollar terms during the first half of the year. However, nearly all of these gains came from Vingroup-related stocks. We remain cautious on the group, given the continued losses in its EV business and a complex corporate structure. In addition, the cross-holding amongst the listed companies in Vingroup ecosystem inflate the group presence in the VN Index. We're far more optimistic about the broader market, where opportunities are taking shape. Valuations remain attractive, with the VN Index trading at a 12-month forward PE of just 11.7 times. Investor sentiment is also gaining momentum, supported by a wave of upcoming IPOs and the potential FTSE emerging market upgrade in September. With strong macro reforms underway and continued progress in capital market development, we believe this is a favorable time to accumulate shares, particularly in financials, consumer sectors, and industrial parks. Overall, Vietnam is entering a new phase of growth, driven by bold reforms and rising infrastructure investment. While external uncertainties remain, strong fundamentals and an improving investment landscape are setting the stage for lasting opportunities. As the economy and capital markets continue to evolve, we believe this is a timely moment to stay focused and positioned for what lies ahead.